Chart of the Week with Redmayne Bentley.
You're listening to financialradio.co.uk. My name's Giles McMullen, chatting to our regular Chartist Bill Rook from Redmayne Bentley. Bill, thanks for joining us today. The markets have been in a complete mess recently. We've had all the troubles with the US bank Bear Stearns. In fact, we're going to have a look at that chart today. Bill, why have you picked this? Obviously, it's in the news, but what are you trying to show?
Well, last week, Giles, we sort of have trainees who pop in every now and then to see how work experience, to see what brokers do and what we look at and how we assess risk and invest in certain products. But I drew his attention to the orange arrow, which is the 180-day low, which you can see on this chart, occurred in mid-June of last year at about 143, and what I wanted him to do was to identify when to get out of an equity, whatever it is, or when the story doesn't match up with what the chart's saying. And this is the 180-day low. You asked the questions, and if he was sitting beside me now, looking at this chart, he would point at that and say, "There's a problem there." And that's all I wanted him to learn, was when there'll be a problem. He can believe what he likes, but he wouldn't be in that share below that 143. Or if he did, or if he was in that share, he'd be asking questions as to why I'm in there. What am I expecting from this share at this level?
And you're right. I mean, the moment it went through that 180 low, it never really recovered, did it?
No, it's a warning point. You see, you've actually got to reassess what's going on here and where your exit strategies are, what your beliefs are about what the forecasts are, where things are going to go. Sometimes shares will bounce on this level, and other times they won't, and it's a time to reassess and to put stricter stop losses in after this, because up to that point you could see from 2004 onwards it's sort of pretty much okay. Lots of black lines suggesting 60-day highs coming through there, but that 180-day low was the end of that share really, or the end of the chart until it became a new trading opportunity, which it hasn't done. There are no arrows pointing upwards, and it's all down since. And in fact, there are 3 other opportunities to short the stock or to sell it since then. So it hasn't been an easy ride. But as I said earlier, I don't gloat over people who have these sort of situations of these shares. It's very important to understand why you've got this share. Can you change your trading strategy using 180-day lows as possible exit strategies, or where will you go from here, really? And I say I don't gloat on those issues. I don't want to either, and it's very important for people to reflect for themselves on what those trading strategies are when things go below their 180-day lows.
I mean, would you go further? Would you not only close a position that you had open, and would you short it once something had gone through the 180-day low? Well,
you could do. Now, what I've done at the bottom of the chart there is this is the 50-day above the 200-day on the S&P. Now, whereas green suggests that the overall trend of the market's okay. Now, the problem with this going short at the optimum time, say in June last year, was that the 50-day was above the 200-day on the S&P, and it was difficult because the overall trend of the market was up, yet the banking sector was clearly on the way down. So you're going against the sector. So it's much, much harder. So you could have done, I suppose, if you'd used a tight stop, and you would have probably been stopped out at 130 had you gone short in June and sometime in September, where that little face comes up. That's the stop point, and it's much, much harder going short in any situation, because it's sort of it's a different way of trading, and I find personally going short very, very hard. I haven't met many people who can short properly, and it's sort of a different art in itself. And actually, given that equities trend longer term on the upside, you don't have very many opportunities to go short to practice your skills out.
Okay, so that's Bear Stearns, and a very good example there of the 180-day stop loss, or the 180-day level that you like to use. Moving on to the... Sorry,
the 180-day low is important because it might be, but it just gives you a chance to say, hang on, it's gone to the 180-day low. What shall I be doing here?
Right.
You just reassess.
You review the situation.
Review everything. That's right. Yeah.
Okay, we're going to have a look at another chart now of another asset that is falling in value. That is the US dollar. You have the US dollar index, the chart. You've chosen that. Just explain the lines that you've drawn on there, Bill.
Well, the whole thing about the US dollar index is it's geometrically weighted against 7 leading currencies, and therefore we're getting a trend of how strong the dollar is. And it was set up in 1973 after Bretton Woods agreement, and it's trickling away, falling away. What I've done here is look for some support levels on the thing, and around 80 was what I plucked on that one. So it's that's at the bottom there. The vertical line is, well, what about this share? What about this particular chart against gold? And gold started showing strength. It's quite interesting when you start comparing charts of different asset classes together. And this one here suggested that there was a clear change in what was going on in gold at around December 2006. So gold, coming out of a long-term trading range, started to break above 500 and hold. Came down, found support and started moving higher. So the argument for gold has been around since about 2006, although it hasn't been spectacular. It's been steady and upward until the fall off in the dollar index is with more dollars being generated or pushed in by the Fed and the prospect of further rate cuts around. The argument for holding on to the dollar has weakened, and they're moving into certainly other asset classes.
Would you buy gold at these levels? Because it does seem to have raced away in recent weeks.
Now it's hard now because it's it is racing away. I suppose it depends on the perception of where things are going, and I think gold is there is a case for holding on to gold or buying into gold now. There is a case, so long as you think the picture is going to worsen, I suppose. But I think so. I think I would, if you have a reasonable stop on the thing, I would certainly be in that sort of asset class, certainly in the commodity area rather than in dollars. Yeah,
Bill. Now I've got to say, for people that haven't listened to many of these chats with you, just for the record, I mean, you were telling us to get out of banks months ago. You were telling us that commodities and gold were looking good. You didn't like the look of the FTSE 100. You particularly didn't like the look of the FTSE 250. I mean, no. It's been working for you. You've been doing very nicely. Thank you very much, haven't you?
Well, I'm just following a trend, Giles. So trying to follow a trend is all I can do. It's the simplest way of trading. When you start going against a trend, think of taking risks like driving the wrong way down the motorway. And that's what some of these traders are doing, taking positions, thinking that the market's going to drop, or thinking the market's going to go the opposite way. It's too risky, and I don't like taking risks. And there's enough risk in the market in itself, whether the trend's going to be maintained as to whether the gold will continue upwards or not, as to actually say, well, it's going to call the top or call the bottom. Calling the tops or bottoms, it grabs attention. It's you're being a starlet for a moment, and you're capturing media. The media will like you for a moment, but I think the risks are very, very high, reputation-wise and all sorts of things. I don't need that. I just like following simple trends, and I like keeping it simple and following trend strength.
Bill,
that's the key, really.
Bill, we'll chat again next week. Thanks very much for chatting to us today.
Thanks, Charles.
Chart of the Week with Redmayne Bentley.